financial markets are generally doing pretty well. We can see here on the far left, U.S. stocks are up about 7% in the first quarter. International is up about 8%, did a little bit better. For developed markets, emerging was up 4%. Even real estate put up a positive number, global real estate. And this is all I mentioned before, kind of what the headwinds have been facing. You think in terms of all the different headwinds or headlines even that have been dominating this last quarter, whether it was elevated inflation, the Federal Reserve tightening monetary policy, or the debt ceiling debate, and certainly the banking crisis that we're going to hit on. There's been a lot of things that have seemingly would have stopped out the market movement, the stock market movement, but it's continued to advance higher. And again, it's a reminder of how the stock market and the economy don't always move lockstep. Oftentimes we see those, they diverge or they go in different directions at different times. And so the market has had some recovery that started really the last fourth quarter of last year. We're still 13% off all-time highs. What we have boxed out here in red is just an index or a measure of valuation. So a price earnings ratio on a forward earnings basis, 18.2. It's a little bit elevated. It's a little higher than long-term averages, but not extremely overvalued. Dividend yield compared to prior time periods, again, not too far off. When we think about valuations, it gives us one measure of how companies are being priced relative to the earnings they're generating. In the short term, there can be more noise. We see more swings in markets. But as we stretch out and look at over longer periods, such as 5-year periods, that's where we start to see valuations, as we look at them today, have a kind of more kind of reflective kind of forward expectation. We're comparing short-term treasury bond or treasury interest rates from 3-month all the way to 30-year. And we draw that line across there to kind of get an idea of what's the slope or the shape of the yield curve. Now, typically you'd see shorter term rates lower than longer term rates. But right now it's flipped, where we have longer term rates that are shorter than or lower than shorter term rates. Now, timing on this is certainly unknown. Perhaps it's later this year into 2024, but we do expect short term interest rates to fall. And it's market participants, it's the Federal Reserve, and it also in line with their long term projection. So in the green box here, we're looking at the U.S. aggregate bond index. Think of this as the bond market. If interest rates were to fall 1%, we would calculate then that the aggregate bond, the bond market between income and price appreciation would advance about 11%. That's the duration, that's the offset, the diversification that we're talking about in terms of owning duration inside of a bond portfolio to help offset stock market volatility. Unemployment rate currently, you can see 3.5% in that bottom kind of right part of the page. Really low level of unemployment. The jobs market's been very strong, and that's one reason why the Federal Reserve has continued to be able to push rates higher kind of throughout this first part of the year. Again, the Fed's moving rates higher to snuff out inflation, but they also want to make sure the jobs market stays, relatively intact. And because it's been so strong, they've had more room to kind of push rates higher without impacting it thus far anyways. 6 indicators that the National Bureau of Economic Research uses to determine when a recession has occurred. Important to remember, recessions are backward looking by design. They're evaluating things that already happened, indicators that already have been posted in terms of the data, and determining, are we in a recession? When did it start? Now, there's several components here looking at primarily around the health of the consumer and the health of businesses. The point to take away here, though, is that yes, things are starting to deteriorate. We are noticing that across some of those data points. As far as when a recession could occur, I mean, some of the research we follow, as well as looking at some of the data, looks like perhaps later this year or into next year is a possibility. The important thing to know, though, is that the recessions that have occurred in the past to that extremeness may not occur again in that way. And this, if we go into a recession based on what we're seeing, is that it may not be a deep or severe recession. The US dollar index, anytime we think of currencies, think of in terms of currency pairs. So it's a US dollar compared to some other currency, whether it's the Chinese yuan, whether it's the euro, the yen, it's always relative to another currency. Now we're looking at here is a US dollar index. That's the US dollar compared to a basket of currencies. We went back here to September of last year. And that was the peak of the US dollar, was in September of last year, on the 27th actually. In that time period, we've seen about a 10-11% decline in the dollar relative to other currencies. The other thing we'd point out here too is that the trend over the last really 15 or 12, 13 years, we've had a pretty, steady rise in the dollar too. Now it's been choppy along the way, but for the most part, the dollar has strengthened, the dollar's appreciated over that time period. We don't believe that the dollar is going to be going away anytime soon. Okay. And some of the main reasons for that is to be a supreme currency, you need to have stability in the country, and that's an important part. You have to have a rule of law and trust in the laws being upheld, and you have to have deep capital markets. And those things are difficult to replicate across the globe. The US dollar has held that for a reason, because those things have held true. What we're looking at here is just comparing US performance versus international in streaks of time period. And you can see here where that red arrow is that we had a streak from 2008 until about 2021, about 14 years or so, where the US dollar was appreciating. And during that time, it was more of a headwind for international investments. Now, it's too soon to say if this trend will take hold, but in that bottom right circle, you can kind of see where over the last year, international has been outperforming the US, owning international investments. We had a tailwind. By the way, it doesn't mean that international is negative during all these periods or the US was negative. It just means that on a relative basis, we saw generally US outperform international.